Hey, it's Clay Trader at claytrader.com. First off, I understand maybe you're thinking, what kind of bait and switch is this? Just give me a chance, because odds are if you clicked on this with the title that I gave it, you're thinking about maybe trying to use averaging down as a strategy or want to learn more about it. So please give this video a try, because I really think that it'll open your eyes and at least shed some new lights on the things in terms of just how dangerous this strategy can be. And that's why I want to talk about it as the sucker strategy and ask you, are you a sucker? Not trying to insult anybody. I was a sucker. I have no problem admitting that. The problem with this strategy is it has a lot of fool's gold with it, and that's what got me. And then I realized, wow, I've been a sucker this whole time. So I have no problem admitting that. But again, if you're thinking about averaging down as a strategy or want to learn more about it, let me teach you about it. But let's take a look at things from a realistic standpoint. Quick little overview. The question here is averaging down a viable long-term strategy? Long-term being the key word. For whatever reason right now, it's a very hot topic. But when I stop and think about it, it's one of those topics that a lot of people, I think, are always wondering about. And unfortunately, a lot of new traders, amateur traders, fall into doing, whether or not they mean to. They end up doing it. So again, hopefully this video can really kind of just act as a little voice on your shoulder saying, hey, remember that video? This is not what you want to be doing. I do want to differentiate between averaging down and position building. There is a big difference. We're going to look at two case studies. And just as kind of the overall tone to the video, there's going to be no theories. There's going to be no assumptions, no generalizations. I'm not going to be making blanket statements. The judge here of this strategy is not me. The judge is mathematics. And I'm just going to leave it at that. You'll see more of what I mean by that going forward. And then at the end, we're just going to quickly recap things in terms of what can we learn from these case studies. But I think that as we go through the case studies, it'll be pretty clear in terms of what those lessons are. Now, real quick, what is averaging down versus building? I want to cover this because a lot of people say, hey, Clay, I see you averaging down in your live trade videos. Well, I'm not averaging down. I am building a position. Let's first cover, though, what is averaging? Averaging is when you go long or short with the goal of keeping your share price as close to the close to the current share price as possible. So you're going to have a share price, and the more and more shares you buy, you're going to have an average price. Well, you want to keep that average price as close to the current price as possible. Now, the way you do this is by starting small, and then you start to increase more and more. And by doing that, like I said, that's going to make life easier in terms of keeping your average share price close to the current share price. Now, in terms of building a position, and this is what I do, the big difference comes from knowing up front how many shares you want to buy. Knowing up front how many shares. And then once you have all these shares, you're done. You're done buying or shorting whatever side of the market you're playing. So let's just say I want 500 shares. As soon as I get 500, I'm done. At that point, I locate an area for a stop loss. I put my stop loss in, and then I manage the trade. The minute I say, you know what, I want 500, then all of a sudden, well, I want 600. I want 800. I want that is averaging, and that's not what you want to do. So building, you know up front, how many do you want? You get to that spot, all right, let me locate a spot, put in a stop loss. Now let me manage the trade. Averaging, your focus is just, you know what? I want to keep the price as close. I want to keep my average cost as close to the current price. So that's the big difference there. In my live trades, I know up front how many shares I want, and when I get to those, then I start to manage the trade. I put in the stop loss, and I'm done. But that is not the same as averaging. So big difference here. And but it's a very slippery slope. If you say, a lot of people will trick themselves, say, yeah, I want 500 shares, and then all of a sudden, well, I'll go 6. I'll go 8, and then before you know it, you're up to 2,000 shares. So if you're not disciplined, if you don't, if you're not able to honor your plans, don't even try to build a position. Just stay away from both of these. Well, definitely stay away from building or averaging, excuse me. But don't even go near building either, because you're going to end up slipping down into averaging, which, as you're going to see, is not where you want to be. So enough of the PowerPoints. Let's take a look at some case studies. And like I said, I'm going to use mathematics to show how averaging down works as a strategy, and let's see how things play out. So what I now want to do is look at some actual case studies and assign some mathematics to it. Again, no generalizations, nothing like that. We're just going to keep it with math. So, and I'm just making this part up, but let's say that your averaging strategy is going to be some sort of numerical system. You're going to have some sort of you should have some sort of logic and system to it. So let's just say that you want to start small, so you would start by buying 50 shares. And you pull up this chart and you see, wow, this chart was up here, and check out this big pullback. This thing is getting overextended to the downside. So you want 50 shares at 66.44, let's say. So you're going to pick some up at 66.44. Now don't ignore these numbers down here, but at that point, you're going to have 50 shares. So your average cost is going to be 66.44 just simply because, well, that's where you bought in. Your gain and loss is going to be 0 because, well, you know, the price is currently right at where your first buy is. So that's fine. And let's say your numerical sequence is, you know what, if it drops down another 50 cents, then you want more shares. So 60 or 50 cents from there would put it at 65.94. But now if it goes there, what you're going to want, or you'd want another 50 shares. So at that point, you would have 100 shares. So let's see what happens. Right there, you can see that it drops all the way down to 63.77. But let's say the way your sequence works is, okay, well, at this point, you want to double down, quote unquote double down. So what means, how do you double your position? Well, if you have a total of 100 shares, then in order to double your position, and again, the logic here is you got to keep the price as close to the current price as possible. So you would want 100 shares, and again, if you're sticking with your sequence of letting it fall another 50 cents, then that would put you at 65.44. So that would give you a total of 200 shares now. And let's run these numbers. And that would be your average cost would be at 65.22. Also want to keep in mind over here, this number is important because this is your distance to break even. So now in order to get back to this point, your average cost, remember, you got filled right here at 65.44. So now it's got to go up 38 cents in order for you to get just back to break even. But keep in mind, this move here went all the way down as low as 63.77. So as a part of your sequence, let's just say, you know what, I got to double down again. So in order to double down, if you have 200, well, then you would need to now buy another 200. Case in point, remember, you're starting small and then you're increasing. And that, again, allows you to keep your average cost close to the current share price. So 65 or 50 cents away from that would put it at 64.94. And this would bring your total shares to 400 now. So you would have 400 total shares. Let's run the numbers on it. So now your average would be 65.32. So notice, you are averaging down. You're bringing down your average share price. The price does now have to travel 44 cents in order to get to your break even. Again, though, it went as low as 63.77. So let's say at this point you're saying, you know what? You've done your 3 50-cent areas. Now you're willing to let it fall an entire dollar before you buy any more shares. So an entire dollar from there is going to be 63.94. Again, you started by just going down 50 cents, 50 cents, 50 cents. But at this point, you say, you know what? I gotta let it. You know, I gotta be wise with my my systematic strategy here. But when it's time to double down, again, in order to double down, you're going to need to now buy 400 shares. So that's going to bring up your total to 800 shares. So let's bring that down. So now your cost is 51,000. Maybe you're looking at that and saying, holy smokes, I don't have 51,000. Well, that's kind of one of the sucker parts of this strategy is you need a lot of capital. And maybe something, that's no problem because I have a margin account. Yeah, just keep that in mind. But let's just assume that you do have, that big account. Again, though, the price, so your average cost now is 64.66, and the price, like I said, went all the way down to 63.77. So your next buy would be because remember, at this point, your systematic strategy says, well, no, you're only buying every dollar, fall. So right here, it would need to go down to 64.92 or 62.94. That did not happen. However, look at this. Now you had the price drop all the way down here. So let's go through the sequence. So at this point, it went as low as 61.17. But let's stick with this. So at that point, again, you need to buy 800 shares because you got to keep on doubling down. So now that brings up your share price to, or your share, I should say your position to 1,600 shares. Now you have 102,000 in it. Your average cost is 63.80. But again, you want to have 61.94 because you got to let it fall an entire dollar. That's what your system says, okay? But at this point, in order to keep that average price close, you got to buy 1,600 shares. So that's going to give you 3,200 shares now total. And let's see. So now you'd have 200,000 into it. Notice what keeps on happening with the loss. It does not go any further because your next buy would need to be at another increment down, but it doesn't go low enough. Again, only goes as low as 61.17. So this would be where your buy starts. So let's see what happens during the next 5 minutes. Okay, it bounces back up, and it bounces up as high as 64.82. Well, at that point, look what your average cost is. It goes up as high as 64.82. So that is going to go above what you have. So I'm going to run the math on that, but let's just assume, for argument's sake, that you get in, or that you were able to sell every single one of your shares, which is definitely assuming the best case scenario, because this assumes that you play it perfectly and sell the exact top, which is 64.82, and along with that, you're able to sell all 3,200 of your shares. So let's just run some math real quick. Again, your average cost was 62.87. The highest it went, so right here, it went up and hit 64.82. So you're going to subtract 64.82 from 62.87, and that gives you a gain of 195 per share. How many shares did you have? Well, you had 3,200 shares. So what's your profit on this trade going to be? The profit turns out to be $6,240. So yeah, this one worked out pretty well. Your sequence worked out very nicely. Hey, fantastic. Very nice little trade there. $6,240. One trade. Again, each of these represents 5 minutes. So all this happened in about 20 minutes. Not too bad for 20 minutes. Let's go on to another case study. So same exact chart. This part right here, you're thinking, you know what, just made over $6,000. It's still super, super overextended. So you're thinking, you know what, if it hits that low right there, I want back in. And you're going to start your sequence, your system, whatever you want to call it, back over again. So if it hits the level of 62.16, again, 62.16 is just simply the low of right there. So that would make sense from a charting perspective. So that's where you want your first entry to be. So again, you would have 50 shares at 62.16. Your break even, obviously it doesn't have to travel anywhere because you're already right at break even. And then let's just go through our sequence. So again, the sequence states if a 50 cent falls, so that would put your next buy at that. Again, you want to double up, so you buy another 50. So let's see if that part gets hit, and you can see another big fall. So this one goes as low as 58.27. So going through our sequence, which we just said or saw, you're going to have quite a few more entry points. So along with that, we'll say, you know what, the next sequence after that, 50 cents below. This is nothing new. This is what you did on the last one. And then after that would be 60.16. Now remember, you have to actually, and after the first three 50-cent drops, remember from the last time, that's when you start to say, okay, now I'm not going to buy every 50 cents. I'll let it drop $1 before I go again. So 59.66 is what you would buy at, and then 58.66. And on this drop here, again, it goes down to a low of 58.27. So all the way down there. So all these cells would have been, and we're assuming that you're super fast on your, order entries, that you're able to take advantage of this. This all happens in 5 minutes. So some more assumptions that you're playing this perfectly and you have all this set up. So here, remember, you got to double down. So that's another 100 shares you would got to get, with the goal of keeping the price as close as possible. So let's run the numbers on that, see where we're at. Okay, there we go. Then again, right here, you would need to buy 200 shares at that sequence spot. So let's run the numbers there. Okay. Here you would need to buy 400 shares, right? Because you got to keep on doubling down to keep that average cost as close as possible to the current price. So at this point, your average cost is at 60.38. And then we have that final part in the system that we need to buy. So that would bring you up to 1,600 shares. And now at this point, the average is 59.52. So in order to make any sort of money, or let's say in order to even break even, the price has got to travel 86 cents from where it currently is. So you can see right here, it goes up and hits a high of 60.38. Now again, what did I say our average cost is? The average cost is at 59.52. It goes up and hits a high right there of 60.38. So again, let's assume that you play this absolutely perfectly. You sell every single one of your shares, which is 1,600 right up at the top. So what's the breakdown for that going to be? So again, let's run the math here. It went up as high as 68.38, which is right there. Your average cost is 59.52. So you're going to subtract that to find the difference. So you made 86 cents per share and you own 1,600 shares. So let's run the math on that. So check it out. $1,376 that you just made on that trade. Not too bad. Again, let's add up our past two trades. We had 62.40, and then you add that together, and you're at a total so far in terms of trade profits of 76.16. Again, each of these is 5 minutes, so not looking too shabby. All right, so you're up about $7,600. You think, you know what? Look how overextended this is. Let's start the process. Let's start the logistics, the system, the sequence, whatever you want to call it, the pattern. Let's start it all over again. So the low of this candle was 58.05. So you're saying, you know what? If it goes down and hits 58.05, I want my first 50 shares. So again, 50 shares, and you want those now at 58.05. Let's see what happens. You can see that it falls, and at this point, it drops down as far as 57.10. So you hopefully are starting to kind of learn the pattern sequence here. We're waiting for 50 cents. So again, it drops down and hits the low as 57.10. So you would get, let's just type in our numbers here and we'll go at one at a time. So remember, at this point, you want to double down. So that's going to give you 100 shares. Now, if it drops another 50 cents, that'll put it at 57.05. And it does indeed hit 57.05. Again, it goes as low as, or actually I take that back, I'm sorry. It goes as low as 57.10. So this order here would not be filled. So right there, that's where it would currently be sitting at. Get rid of these ones. So you would be at 57.80 right now with 100 total shares. Let's see what happens with that next candle. And you can see right here another big plummet. So we're going to have a lot of our patterns or sequence orders filled here as this goes as low as 53.67. So the first one that would be filled is, remember, we got to go another 50 cents down. So the total shares right there, that's going to bring total up to 200 shares. And then for that, you'll see, or excuse me, already have the number there. So average of 57.43. So I got those numbers out of there. Don't want to confuse things there. So the next order after the 57.05, 50 cents from that would be 56.55. And at that time, remember, you got to double down. So you would want 200 shares at that point, which would bring your total up to 400. Let's bring that down. So now you can see average cost $56.99. But again, this goes as low as $53.67. So at this point, we transition from 50 cents to $1. So we already know that gets hit because we know that candle drops quite a bit. So now you're at 800 shares. Your average cost is $56.27. Next one in the sequence going to be $1. So in order to keep that price the same, you're going to have to pick up another 800. That brings you up to 1,600 shares. And I believe one more would get hit because it went as low as, no, it would not, because the next order would be at 53.55, but this low only goes as low as 53.67. Would you get filled on this next one? So right here, it then goes down as low as 52.51. So yeah, this next sequence would get filled at 53.55. You would need to pick up those 1,600 shares. That brings you up to 3,200 shares now. Oops, let's extend that out. The number's getting so big, ran out of room there. So that's where that stands. Now at this point in the sequence, let's say, all right, I've done 3 50-cent moves. I've done $3 moves. Now it needs to go $2. So the next area in the sequence would be 51.55. But as you can see here, it drops as low as 52.51. So you would not get any fills there. There it drops as low as 52. So again, no fills there, only drops as low as 52. And remember, your average cost is 54.48. And here it goes up as high as 55.37. And right here, it actually goes up as high. So we'll say that you really time it up well and you are able to sell at 56.10. So again, we'll assume you sell it at the top, all your shares, all 3,200 of them at 56.10. So we'll go through the math again. It hit a high of 56.10 right there. Your average cost is 54.48. So what's the difference between those? $1.62. You had 3,200 shares. So let's calculate the profit on that. That would give you a profit of 5,184. So for these three trades, what is your total? Your total would be right here at $12,800. So three separate trades, averaging down your pattern, your logistics, your sequence, whatever you call it. $12,800 on the trade. So the LL. Very nice trade. You averaged down. Your sequence worked out well. Now, again, we're assuming that you have a massive account because it took some capital. But hey, you came out on top, $12,800. Okay, so now you come across the KATE. And, same type of thing. You see a nice move up. It's pulling back. Hey, look, a hammer candle. And we'll give you the benefit of the doubt. Let's say you time it up and say, you know what? I want the bottom of there. So if it goes down to 41.34, you want in. And, of course, the process right now. Start off with 50 shares. So let's take a look at this next candle. All right, well, this next candle, nice. It pulls back. It fills you there, but it looks like, you know the sequence by now. Some more orders would get filled. So the next point in the sequence would be 50 cents below. At that point, you would want to pick up another 100 share or another 50 shares, giving you a total of 100. Now, as you can see right here, this movement actually only goes down as low as 40.35. Why do I bring that up? Well, the next spot in the sequence would be 40.34. So you would have missed out on that part in the sequence by just a penny. So sort of frustrating. But let's see what happens with the next candle. And you can see right here, the next candle, quite a bit of a collapse. So let's go through our sequences now, because again, we're assuming just like the first three trades that you're fast and you got plenty of time to get your numerical pattern the way you buy. So the next one, you'd need 100 shares. So that would give you 200 shares, and it'd be at that 50 cent mark. So there you go, 50 cents from there would then be 39.84, and as you can see from the big move, you would definitely get filled on those. So now you're at 400 shares. Sorry, I got rid of those again just so no confusion happens. So let's bring that down. So your average is at 40.28. And then at this point, remember, this is when your strategy goes, all right, now I'm only willing to buy every dollar move. So at this point, you would need to have 400 shares. That's going to give you 800. So let's go with the math there. But again, this one goes all the way down as low as 36. So you got some more sequences to fill. Again, here you would only want to be interested at 37.84. Got to give it $1. And again, double down. So you have that. So let's keep on tracking that. And then the next buy would be at 36.84. And again, it went down as low as 36. So yes, you would have been filled on this one, all in the same candle. And at this point, you would be needing 600 or 1,600 shares. So that brings you up to 3,200. So now your situation is looking like that. Next thing to note is at this point in your sequence, you are now only willing to buy every $2. So the next point where you would buy would be at 34.84. You got to let it go $2. So let's see what happens with this next candle. And you can see right here, it goes as low as that point, which is at 33.79. So you would have been filled right here, $2 less. So at that point, you'd be needing to buy 3,200 shares. So that would bring your total shares up to 6,400. And the next buy point in the sequence, remember, you're at the $2 phase now, so you can't buy anymore until 32.84 because that's what your strategy says. So at this point, it went only down as low as 33.79. So those ones would not have been filled. Let's see what happens with the next candle. And then the next candle, you get that. So this candle goes down as low as 31.60. So this one you would need to buy 6,400 shares. So that would bring your position up to 12,800 shares. So now you can notice now, you need quite a big portfolio, but your average, 34.57. So, but at the same time, your loss is getting bigger. And now look how much further up to break even. The price has got $1.73 just to get to break even. The next order in the sequence would be, remember, 30.84 because we got to wait $2. And this one goes this part goes as low as 31.60. So you would not have been filled there. And then this candle here goes as low as 31.22. So again, not filled there. This move here goes as low as 30.06. So yes, you would have been filled there. So at this point, you would have needed to buy 12,800, bringing your total up to 25,600 shares. And at this point, you're looking at, so now you're sitting at all these numbers here, and then just to kind of, it bounces around. Notice there are no bounces up. There it bounces a little bit. Remember, your average is at 32.71, so it's got to get up to right around this area on the chart, someplace up above 32. And you can see right there, it ends up rolling back over again, and then drifts that much further in the downwards direction. And just for fun, let's say, well, your next sequence would be at 28.84. And you can see here it goes as low as 28.30. So yeah, hey, you would be able to buy shares there. You need to buy 25,600, which would bring your total shares up to 51,000. And then let's just bring this down. And remember, the share price continues to fall. So you would be in 1.5 million. And you can see here the price just continues to go sideways and it suffers. So now look at your loss, 98,975. And the crazy thing is this is just starting at 50. What happens if you had started with 100 up there? That loss would be that much bigger. But besides just assuming that you had 1.5 million in your account and margin, I mean, this is quite possibly your account is blown up, because especially if you're on margin, you're going to be getting margin calls. Your broker is going to liquidate things immediately. So we're doing a lot of assumptions in your favor, saying that you could even absorb this. But what did we say? What was the gain from those first three trades? 12,800. So 12,800 versus what? Negative $98,000. And I'm not making this up. You saw the spreadsheet. You saw how the math operated. You saw the charts. And again, we're assuming that you're nailing bottoms. We assumed for this 12,800, remember, we assumed that you actually were selling the tops and doing very well. And yet, even with all those positive assumptions in your favor that gave you the 12,800, all it took was one, and not only are these gains completely wiped away, but your whole account could potentially be absolutely evaporated. So keep that in mind. Again, this is not my opinion. This is not blanket statements. This is not generalizations. This is math. You follow the pattern, your strategy, your numerical sequence, whatever you want to call that. You followed it. It worked out those 3 times, and hey, it worked out $12,800. Wow. But all it takes is that one time where you get caught in something like this, which is just a total train wreck, and you never get any bounce at all. And following the same exact sequence, not only would you have needed $1.5 million, but it still never bounced and still kept drifting downwards. And at this point, that's basically a $100,000 loss. And we're assuming that your broker wouldn't have stepped in by now. So consider that. Remember these case studies when you're thinking about averaging down. 12,800 wins versus all of a sudden one of those. Talk about lopsided risk versus reward. Remember, you were batting 75%. But let's just say you get up to 90%. You're right 90% of the time. Still, all it takes is one of these, and you may no longer be a stock trader. So you just saw the case studies, and hopefully you're saying, "Oh, that's nothing to be taken lightly." And this is why I say it's fool's gold for suckers. And I hesitate to say this because I don't want. Hopefully, the reason I'm saying it now is you've seen the examples, but it does work. Averaging down works, and it works quite often. And don't take that as me saying, so get out there and do it. No, I'm not saying that. But it's one of those things where, yeah, you can have a high win rate at it. But the problem is, as we saw, it only takes that one time, and then all those high win rates are just, exploded, just blasted out of the water. So yes, it does work, and it works quite often. However, remember, the bad thing here is there's no commitment to risk management. When the overall philosophy is some, derivative of or variation of, I stop buying once my margin is maxed out, that's not managing risk. That is playing with fire. Sure, lots of times it'll work out. And it'll work out and say, wow, I just made a nice score there. But it just takes that one time when your margin is maxed out, and then it's, lights out, party over, bon voyage. It's game over. The other thing that you notice, I'm sure, is you need lots of cash, and then you need to be able to margin it. And margin can be the devil, especially when you're implementing strategies like this. And as you saw, that capital required, it adds up very quickly. Sure, at first, and when we're at 50 shares, 100 shares, okay, 400 shares, 800 shares. But then when you start to need to keep on averaging and averaging, all of a sudden, exponentially, your capital needed just goes off the charts. And we assumed, of course, that you had a massive thing, but the capital adds up very quickly, and then all it takes is one. While I'm not going to say it's going to be an utter disaster where your whole portfolio is blown out of the water, it is possible. So keep that in mind. It is possible. It's not unrealistic at all to say that all it takes is one loser and you have given away all your gains for weeks, if not months. So that part is not unrealistic at all. While it is sure it's possible to totally blow up your account, I'm not going to say that's for sure going to happen, but what will happen is, you'll give away weeks and weeks of gains. So you could be on a 4-week win streak, and all it takes is that one trade, and all of a sudden those 4 weeks down the toilet. And I just want to end on this. I have no hidden agenda. I don't. It's just one of the things. I'm getting all sorts of questions on it, and this is not my opinion. It's a mathematical fact. You need the price to go in your way or in your favor, and at that one time where it doesn't, the way the math works is, and as you saw on the spreadsheet, the losses add up very quick. The capital required adds up very quick. And all it takes is that one final failed little move in your direction, and your broker is liquidating your account because, hey, your margin is maxed out, and it can become very ugly. Hey, you know what? 9 out of 10 times, 9.5 times out of 10, it'll be fine. And you'll walk away making money, maybe breaking even, small little loss, a nice gain. But it's just that one time where you just keep pouring in more and more money, and as the math shows, if you don't get that price movement in your direction, it's game over. So that is my stance on it. Stay away. It's fool's gold because it works a lot, but it only works a lot if you have a big enough account. But it's still, no matter how big your account is, at some point, especially in the day and age of supercomputers, when the computers can see that you have big size and you're trying to just continually scale out, even if you're trying to hide orders, it can just get very, very messy. So there's better ways to trade. Averaging down is not what you want to do. And even if you're not trading, even if you're not, day trading, as an investor, if you're, I see it all the time in the world of penny stocks. People keep averaging down and down and down. The same principles here, or, the same principles apply here. The math is not in your favor because you keep getting further and further away from break even. Yet as you're getting further and further away from break even, your loss is getting bigger and bigger and bigger. So if you have any questions, comments, please leave those, in the comments below. I'd like to hear from people, get people's thoughts. But one of those things where avoid this strategy, don't fall for that fool's gold.